Japan's central bank just fired its biggest weapon in years, reportedly spending billions to save the yen from crashing through 160. The Bank of Japan held interest rates steady today, but that's not the headline. Sources say the BOJ intervened directly in currency markets after the yen crossed the psychologically critical 160 per dollar level. This marks one of the most aggressive defenses of the currency in recent memory, signaling real alarm inside Tokyo's financial establishment. Why does this matter? A weak yen makes Japanese exports cheaper globally but crushes purchasing power at home, driving up costs for imported energy and food. Analysts believe this intervention could cost tens of billions of dollars in reserves. It's a clear signal Tokyo won't tolerate unchecked currency depreciation, even while keeping rates unchanged to support its fragile economy. This isn't the first time Japan has stepped in, but repeated interventions raise questions about long-term effectiveness. Global traders are now watching closely to see if 160 becomes a new line in the sand or just a temporary speed bump in the yen's broader decline against the dollar. Next up, escalating tensions in the Middle East. President Trump said, quote, "We just want to win in Iran," signaling that U.S. military action could continue for the foreseeable future. This comes as new attacks hit Kuwait and shipping lanes near the Strait of Hormuz, one of the world's most critical oil choke points. The Strait of Hormuz carries roughly a fifth of global oil supply, so any disruption there sends shockwaves through energy markets worldwide. Shipping companies are reportedly rerouting vessels and raising insurance premiums as the risk of conflict spreads beyond Iran's borders into neighboring Gulf states. Meanwhile, in Gaza, Israel continued military strikes despite Hamas publicly pledging to disarm as part of a broader ceasefire framework. Humanitarian groups warn the fighting has intensified rather than eased, complicating diplomatic efforts to de-escalate on multiple fronts simultaneously. Markets are increasingly nervous about a wider regional war disrupting global trade and energy prices. For investors and everyday consumers alike, this matters because energy price spikes ripple through everything from gas pumps to airline tickets to manufacturing costs. With no clear resolution in sight, traders are bracing for continued volatility across oil, currencies, and broader risk assets in the weeks ahead. Switching gears to crypto regulation, Russia just expanded its cryptocurrency mining ban to include Moscow, the surrounding Moscow region, and parts of Kursk region, extending restrictions all the way through 2032. Officials cite power supply concerns as the primary driver behind the decision. This move significantly shrinks the map of legal mining operations within Russian borders. Russia has taken a fragmented approach to crypto mining, banning it in energy-strapped regions while allowing it elsewhere, particularly in resource-rich Siberian areas. Moscow's inclusion is notable because it's the country's economic and population hub, suggesting authorities see mining's electricity demand as a genuine strain on the national grid rather than just a regional issue. This long-term ban, running nearly 7 years, signals Russia isn't expecting its power infrastructure challenges to ease anytime soon. It also highlights a broader global trend where governments increasingly weigh crypto mining's energy footprint against national grid stability and competing industrial needs. Miners operating in restricted zones now face relocation or shutdown, reshaping Russia's domestic mining landscape for years to come. Meanwhile, Elon Musk's net worth has taken a dramatic hit, falling all the way back to levels last seen before SpaceX went public. His fortune peaked at roughly $1.33 trillion back on June 16th. Now it stands at $684 billion, wiping out hundreds of billions in value in just weeks. The drop stems largely from a broader rout in Tesla and SpaceX-linked shares, as investor sentiment cooled amid wider market volatility and concerns over valuation. Musk remains one of the world's wealthiest individuals, but this swing underscores just how volatile tech and space sector fortunes can be when market conditions shift quickly. This kind of wealth swing, nearly $650 billion evaporating in months, illustrates the razor's edge that even the world's richest people walk when their net worth is tied so heavily to volatile public stock. It's a stark reminder that paper wealth can vanish just as fast as it appears. In regulatory news, the The Bank of Italy just published research challenging one of crypto's most popular selling points. Researchers found no consistent cost advantage for using stablecoins over traditional methods when sending remittances internationally. That directly contradicts the industry narrative that blockchain-based transfers are automatically cheaper and faster than conventional banking rails. According to the study, fiat currency conversion costs and existing payment infrastructure, not blockchain transaction fees, accounted for most of the differences in both cost and settlement time. In other words, the bottleneck isn't the crypto technology itself, it's what happens when digital assets meet the traditional banking system on either end. This is a significant finding for policymakers and crypto companies alike, since it suggests real remittance savings require fixing legacy financial infrastructure, not just adopting new blockchain rails. It's a sobering dose of reality for an industry that's long marketed stablecoins as a silver bullet for global money transfers. Turning to the markets, Bitcoin has sunk to two-week lows as U.S. stocks failed to replicate a relief rebound seen earlier in Asian trading sessions. This divergence between American and Asian markets is creating fresh uncertainty for crypto traders watching for broader risk-on signals. Bitcoin has historically tracked broader equity sentiment closely, so when Wall Street trades sideways while Tokyo and other Asian markets bounce, it exposes cracks in the correlation. Combined with ongoing geopolitical tension from the Middle East and currency intervention in Japan, traders are facing a genuinely complex macro picture this week. Volatility across currencies, oil, and equities is spilling directly into crypto sentiment, and this pattern of Bitcoin lagging behind global risk assets is one analysts will be watching closely in the days ahead to gauge where broader market confidence is truly heading. Finally, some major regulatory news for stablecoin issuer Circle. The company has officially secured a New York trust charter, a significant milestone as crypto's regulatory push accelerates across the United States. This charter gives Circle enhanced legitimacy and oversight status within one of the most important financial jurisdictions in the world. New York has historically maintained some of the strictest financial regulations in the country, so earning this trust charter signals growing institutional acceptance of Circle's USDC stablecoin operations. It comes amid a broader wave of regulatory clarity efforts happening across the U.S. crypto industry this year. For everyday users, this kind of regulatory approval could mean more confidence and eventually broader adoption of stablecoins in mainstream finance. It's another sign that traditional regulators and crypto companies are slowly finding common ground after years of friction and uncertainty. So here's the big question for today. Will more central bank interventions like Japan's become the new normal as currencies face mounting pressure worldwide? Let us know your take in the comments below. And if you want twice-weekly deep dives into the stories shaping markets and crypto, hit subscribe right now.